welcome back to another video. Today we're going to get into the guide to fair value gaps A through Z. So in this video overall we're going to go over the intro to fair value gaps 101, some A+ setups for fair value gaps, and hidden secrets for success trading fair value gaps that I've learned along the way. So overall we're going to go over breakdowns, chart examples, and definitions. But before we begin, make sure you guys are following me on Instagram. Tons of breakdowns, chart examples, analysis, as well as I do document my trades that I do take as well on there. Lots of free education, lots of free knowledge on there. Make sure you guys are following me if you guys are not. But let's get into the video. Alright, intro to fair value gaps. But before we begin to digest the fair value gap, we have to understand how does the algorithm work. ICT refers to the market as seeking balance. This is why over the course of a whole year, the market has just as many red days as it does green days. The market is never going straight up or straight down. For it to go higher, it has to go back lower, and for it to go back lower, it has to go back higher. Basic market structure 101. ICT recites painting as the best answer to why fair value gaps work. Let's say you're painting a wall, you paint a coating on one side from up to down. On that coating, you have little spots. You grab your paintbrush and you cover over those little spots, making sure the entire area you just coated has paint. This is how ICT refers to fair value gaps. When the market goes higher and leaves an imbalance, also known as a fair value gap, price has to go back lower or higher to then reprice that inefficiently traded level, like the paintbrush coming back to repaint another coating of color over the spots. Think of the market as the paintbrush and the fair value gap as the spots left in the marketplace. The market leaves both tiny and big spots in the marketplace. As the marketplace paints new candles, when it leaves those spots, price has to eventually come back into these spots and repaint over them before then continuing. This is why ICT refers to the market as a work of art. I hope that makes sense. Okay, we have two examples here. Before we have this painter, as you can see, this is what I mean by the spot. So she's painting a coating on this wall and there's little spots here. So obviously you don't want these little spots there. So what she's gonna do, she's gonna grab a roller and she's gonna paint over those little spots. As she's going down, spots are being left. So what she has to do is she has to go back up, clean out those spots, and then go back down. And this is what it looks like. So as she rolls down, spots are left, so she has to roll back up and then roll back down to make sure that she's getting every little spot that's there to then paint the full picture. That's how ICT refers to fair value gaps and efficiencies in the marketplace. So as the market creates new candles and essentially paints new candles and creates new candles, there's going to be little spots there in that painting to where the market has to come back down to fill in that spot before then rolling back over and continuing to paint. So that's how ICT refers to fair value gaps and the algorithm and how the algorithm works. Actually going into fair value gaps here. So the fair value gap is a 3-candle formation. The middle area is what we want to focus on. The distribution from the first candle's high to the third candle's low. The middle area from high to low extended out, and that's your fair value gap. As you can see, we have 1 candle, 2 candle, 3 candle. This middle area from this candle's high on the first candle and this candle's low on the third candle, this middle area from high to low, that is our fair value gap. And this is what we refer to as the spot in the marketplace. So as the market paints, it creates this spot. So price comes back down, fills in that spot. Remember the painting analysis, price comes back down, fill in that spot, and then continues to paint. And this is what we typically see from a fair value gap. Price comes up, leaves a fair value gap, comes back down, taps into it, and then continues higher. Just like the coating of paint analogy, the middle area in the fair value gap is the spot on the wall. And for price to be effectively delivered, price has to come back into that spot and reprice before then continuing higher. That's your common gap. So these fair value gaps right here, these are called common gaps. There's multiple different type of fair value gaps, but this is the ones that you're typically gonna see, the common. Sometimes in price action, there are times where a price does not come back into your fair value gap. These are your breakaway gaps. Generally, breakaway gaps are the first fair value gap left in the marketplace after taking out an old high or low and a shift in the marketplace is created. That fair value gap is not to be revisited fully. More on this in the secrets to success. We have a depiction of a breakaway gap here. So it's the first fair value gap after taking out a low or high and then breaking structure. As price breaks higher, that fair value gap and the break is the breakaway gap. So as you can see, price comes down, takes out this low, taps into a support level down here, which would, be like your demand zone or your support and resistance or whatever you want to use. This is an order block, so I'll say order block. You may say this is a demand zone. So price comes down, takes out this low, taps into this support level, and then on the break higher, price creates this breakaway gap. That first fair value gap during the break of the reversal, that is your breakaway gap. So just above that, we have a common gap right here. So this is a trade we can take. We could put our limit order right here and this common gap, and we could actually put our stop loss right here on the breakaway gap with confidence that price does not come back down into this breakaway gap. So price comes down, taps into this common gap, stop loss down here, and the breakaway gap, knowing that price will not come down here, and then boom, the rest is history. Quick 2-to-1 R. So this is a perfect example of a breakaway gap. Okay, next we're going to go over the sell side imbalances, buy side inefficiencies, SIBIs, or buy side imbalances, sell side inefficiencies, BISIs. SIBIs, in simple terms, is a big bearish fair value gap, and BISI, buy side imbalance, sell side inefficiency, is a big bullish fair value. Think of these like large spots of paint. The common gap are small spots of paint, and these BISIs are large spots of paint in price action. This is where we incorporate the consequent encroachment, C.E. C.E is the 50% level of any SIBI or BISI. So a BISI and a SIBI, those are big fair value gaps. So when dealing with big fair value gaps, you have to think of it like this. So you have a small cookie and you have a big cookie. You could probably fit the entire small cookie in your mouth and eat it like that, but you can't do that with the big cookie. So what you have to do is you have to split the big cookie in half. And that's kind of how we look at it here. So when dealing with bigger fair value gaps, we split them in half. And that 50% level is your consequent encroachment, or 50%. C.E. If you anchor a Fibonacci from the first high of the fair value gap formation and the third low of that fair value gap formation from high to low, 50% is your C.E. When dealing with larger fair value gaps, it is most important to identify the highest point, then the lowest point, and the 50% level of the fair value gap. That 50% level is the most sensitive and best for catching some really sniper entries. More on this in Secrets to Success, but overall, this is the difference between a BISI and a regular fair value gap. So from this common gap right here to this BISI, what's the biggest difference? Obviously the size. This one is a lot bigger. This BISI is a lot bigger. So when dealing with these bigger fair value gaps, you want to put a Fibonacci from this low to this high, or this high to this low, and put a 50% level. That 50% level, typically price would come back into that 50% level and show support there. So this 50% level is a major support level in price action. As you can see, price comes down, taps into it once, comes back, taps into it twice, comes back, taps into it 3 times, and then 4th time, and then we see a rip higher. So whenever marking out BISIs or bigger fair value gaps, it's important to have the 50% level marked out and paying close attention to how price reacts at that level. Alright, here we go. Some A+ setups for fair value gaps. Primarily, fair value gaps are a way of getting into a trade. You see a break higher, price then creates a fair value gap, you wait for price to come back down, and you take the trade. Here are some setups I look for when trading fair value gaps. The first setup I look for is a breaker structure, a break higher or lower with strong momentum. That's one of the key signs I look for. The break higher or lower indicates that the market is pushing a certain direction where one party, whether the bulls slash the bears, have control, and the fair value gap that it creates in that break is more likely to hold than not. So overall, here we have a really good example of a breaker structure. Price comes up higher and then breaks lower. So overall, it's showing that the bears are taking control. We have a breaker structure where this low is then broken. Price leaves a fair value gap. Price comes back up into this fair value gap, and we can actually take our trade right here. Stop loss above this high, and our take profit down here into this old low, and just like that. That's one of the most common ways of trading fair value gaps. As a new, trader, new fair value gap trader, if you're first learning about this is probably how you would want to trade fair value gaps, aligning with the overall bias and overall trend of the market, waiting for a breaker structure, waiting for the pullback into fair value gap, price showing respect at that fair value gap, taking it, and then setting your take profit or limit order down at a old low or a old high if you're going in long. This is one of the best setups to take and one of the easiest setups to take. Number two, inside of a breaker. A breaker is another one of ICT's concepts where you have a low in price. Price then comes back higher, creates a high. Price comes back lower, creates a lower low, then breaks back higher above that prior high. That last high is now a breaker, and if a fair value gap was created as price broke above that high, that is a very, very good fair value gap. So overall, this is what I meant by breakers. So price creates a low, comes back up, we create a high, we come back lower, create a lower low, breaking out this low, then price then breaks higher, and this old high after price breaks higher, this is your breaker. So price comes back into that breaker and then push higher. Think of this kind of like a head and shoulders. You would probably say this is your left shoulder, this is your right shoulder. This is a lot easier way of looking at head and shoulders. There's a lot more that goes into breakers, but in easy, like layman terms, this is generally what a breaker is, and this is bearish breaker. So we have a high, create a low, we come back up, we create a higher high, break above this previous high. It has to break above the previous high, that's the breaker, and then we break lower, and then we come back into this low right here, and then if a fair value gap isn't formed inside of this, then that's a very good fair value gap. That's called a unicorn, and this is a good breakdown right here. So we come up, create a high, break lower, create a low, we come back up, take out that high, like I mentioned, and then we break lower, breaking this low. So then price comes back up higher. This is the breaker. This last low area is the breaker. And inside of that breaker, look at that. We have a fair value gap right there. Limit order right there at that fair value gap. Stop loss just above the high, and the rest was history. This is a very, very good trade, very good setup, really, really good. A plus. We have near an order block. An order block is a last up close slash down close candle after creating a high or a low before reversal. You may know this as your supply slash demand for easier digestion. A fair value gap near an order block is a strong fair value gap. What could happen is the bodies could remain inside of the fair value gap, but the wicks of that candle will tap into the order block level, which is a great, great signature in price action, indicating that you're about to get a good trade. So this is overall what I mean. As you can see, price comes down, breaks lower. We have a fair value gap right here, and just above that, we have a last up close candle. That's your order block right here. These last up close candles are your order block. Price comes back, taps into that order block with the wicks. You have to pay attention to the wick. The wick taps the order block but the bodies remain inside of the fair value gap, and then bang, really, really good trade. All right, here we go. Some secrets to success. So I'm going to give some of my personal gems that I have learned not only from my own experience, but watching and listening to over 1,000 hours of ICT and his best students. So these are things that I've learned along the way, some things that I found in price action through back testing and forward testing that I think will really help you guys out, whether you're a beginner or a already been trading ICT. So first is using fair value gaps to understand the order flow of the market. During bullish price action, bullish fair value gaps should be respected and bearish fair value gaps should be disrespected, and vice versa for bearish order flow. Understand this logic is very important in multitude of ways, not only as a baseline for entry during a bullish or bearish market condition, but is also a good indication to know when you're off sides. Let's say you're long on a trade. Price comes back into a bearish fair value gap. Instead of disrespecting it, price starts to push lower. One of the key indications to take profits off the table or cut your losses early. So overall, during a bullish market condition, bearish fair value gap should be disrespected. So the fact that price came back up into that bearish fair value gap and didn't disrespect it, or either consolidate and then push higher, but instead starts to look like it's going to reverse, that's a great indication to know to either take some off the table or cut your losses early. So that's one way you can, use fair value gaps as a means of targeting or knowing when you're wrong, as well as overall, during market structure. As you can see here, overall trend is bullish. So overall, price bounces higher, creates a fair value gap, taps into it, taps into it, taps into it, bounces higher again, fair value gap, taps into that, bounces higher, fair value gap, taps into that, bounces higher, fair value gap, bounce, fair value gap, bounce, fair value gap. This is technically how you want to trade the fair value gap right here. What you know as market structure is simply just price pushing higher, coming back into a fair value gap or other one of ICT's models, and then continuing higher, like the paint analogy. If you remember spots in the marketplace, price comes back, reprices, then continues. So this is exactly what I mean by the paint analogy. So price breaks higher, this is your coating of paint, price comes back into those spots of paint, breaks higher, leaves another spot, comes back, fills in that spot, breaks higher, leaves a spot, comes back, and obviously this is how it should look like in a bullish market condition. So if we're overall bullish and price did not respect this, but instead, let's say it pushed higher and then broke lower, that would be a good indication that we're offsides and order flow could be shifting. On the higher time frames, like the weekly, daily, H4, and H1, when you do see larger fair value gaps like SIBI, instead of just focusing on the 50% level, like I said, add two more levels to the Fibonacci. So on the higher time frames, when dealing with bigger fair value gaps on higher time frames, like I mentioned, weekly, daily, H4, add the two more levels. These two other levels are the 25% level and the 75% level. So now you have the high of the fair value gap, the low of the fair value gap, the 25, 50, and 75% level. All the levels are very important. Sometimes price will come down to the 25% level. Sometimes it may stay at the 50% level. Sometimes it could come all the way down to the 75% level. Wait for price to come down into one of these higher time frame levels like 25%, 50%, or 75%. Wait for a break higher on the lower time frames. Wait for a lower time frame fair value gap. And this is overall how you use higher time frame correlation with lower time frames, and it gets you some killer overall trades. So when dealing with higher time frame fair value gaps on the hourly and the daily, you want to mark them up like this. So this is a daily fair value gap. We have the 25%, 50%, 75% level, and obviously the high and the low. So, and we can go from the daily to the lower time frame. So let's say we're on the H1, price comes down into the 75% level. We see a breaker structure higher on the H1. We can then wait for H1 fair value gap. Price comes out into the H1 fair value gap, and then we could catch this trade all the way back up into this supply level. So overall, really good use of higher time frames mixed with lower time frame correlation to catching big moves. Third, breakaway gaps. ICT mentions with breakaway gaps, price should not come back above or below the 50% level. So when you're in a situation where you have a breakaway gap and a common gap just below or above it, what you can do is take the trade inside of a common gap and have your stop loss just above or below the 50% of the breakaway gap if price does get above or below. Fourth, where do you put your stop loss with a regular fair value gap, not including the breakaway gap just above it? Let's just say there's just a regular fair value gap. Where do you put your stop loss? ICT says that your stop loss goes either the first low of the fair value gap formation for the bullish fair value gap and the first high for a bearish fair value gap. So this is a good depiction of where you want to put your stop loss. So we took the trade here and the stop loss goes just above right here, just above right here. So we have the first candle, the second candle, and the third candle that creates the fair value gap. Your stop loss goes above right here for a bearish fair value gap. For a bearish fair value gap, your stop loss goes above right here. And for a bullish fair value gap, your stop loss goes down here. One candle, two candle, three candle, that creates a fair value gap. Your stop loss goes below that third candle right there. And then lastly, when entering into common gaps or SIBIs and BISIs in price action, ensure that when you're using a limit order that you set your limit orders to either the opening or the 25% level. ICT often recites that you have your limit set at the open. Not as often will price come back into the 50% level. So ensure that you get into a trade over trying to be extra precise. Mainly, only times you get in a trade at 50% or 75% level of the fair value gap with a limit order is if there's an order block just above or below that you'd expect price to tap into that order block. So this is what I mean by that order block level. So overall, when trading fair value gaps, you want to set your limit order at the actual opening. You want to set at the opening to ensure that you get into a trade. So overall, when you have an order block just above a fair value gap, this is when you'd probably want to get into a trade at the 50% level to ensure that your stop loss gets above that order block. And this is what I mean by putting your limit order at the opening. As you can see, we have one candle, two candle, three candle. Bam, price comes back down. Our limit order at the opening of this fair value gap. Stop loss down here. Take profit up here. So overall, getting in at the opening of the fair value gap to ensure I get into the trade. Prioritize getting in and being right than being overly precise. Too many times have I tried putting my fair value gap at the 50% level, trying to be precise, and price ends up coming into the opening of fair value gap, taps into it, and then leaves. That's called an IOFED, where price comes just slowly inside of the fair value gap and then leaves. That's when price is in a hurry. So to ensure that you actually get into a trade, I make sure that you guys are putting your limit orders at the opening of the fair value gap. You want to prioritize getting in, and then as soon as we see price start to overall break higher, we could probably scale in as it broke higher to back to our normal risk. But when actually entering a fair value gap, you want to enter at the opening. But when not to enter at the opening, or you can be a little more confident entering at the 50% level, is when you have an order block just above it. And that's about it. Thank you guys for watching. Make sure you guys do like and subscribe, as well as comment down below what I should make a video about next, what you guys want to learn about next, whether that be more about order blocks, market structure, bias, whatever it may be. Put that in the comments and I'll try and make a video about it next. It's been Arkham. See you guys later.